Hello and a warm welcome to this week's edition of Econoday Unplugged on Wednesday, the 25th of August 2021. Terry Sheehan is stateside, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. While globally, recent economic news has tended to be disappointingly soft and, in many cases, weak enough to encourage a downgrade to growth forecasts for the rest of 2021. Just last week, Bank of America Corporation's monthly survey of fund managers found only a net 27% of respondents expecting the global economy to improve. Now, that's its lowest reading since April 2020 and down from 91% as recently as March. Versus expectations, the US economy might not be doing too badly, but COVID is typically having a significant impact elsewhere, notably in Europe, where Econoday's Economic Consensus Divergence Index, the ECDI, is deeper in negative surprise territory than at any time since last November. And of course, for a good number of countries, this comes at a time of overshooting inflation that may or may not prove transitory. Either way, such a combination presents a major challenge for policymakers. Speculation about QE tapering, especially ahead of this week's Jackson Hole Symposium, may be the talk in the markets, but the big picture still argues in favour of caution when it comes to the prospective withdrawal of monetary and fiscal stimulus. Anyway, before we go to Terry and Jackson Hole, this week we have Brian with us, so let's go to him first to find out how COVID is impacting the data and policy in his part of the world. So Brian, if we can kick off with Japan, see the government has just expanded the state of emergency from 13 to 21 prefectures due to the Delta variant. Just last week, Toyota said it would slash worldwide vehicle production by 40% next month because of a global microchip shortage. So what's the assessment of what's going on out there, and just how bad is the effect from COVID and the likes going to be to the Japanese economy?
Well, yeah, it's obviously it's the number one issue to think about going forward. You know, we had obviously the Tokyo Olympics over the last month or so, and you know that might cause a bit of a pop in some of the numbers, but you wouldn't have thought that it'd be enough to really overturn the impact that the virus is having on broader economic activity. I think we're all just at the mercy of what COVID does in terms of allowing us to get back onto this recovery, and so that's obviously going to be something that's disrupting the Japanese economy, but the region in more broadly.
When it comes to, I mean, certainly as far as the European Central Bank, the Bank of England, and probably hear from Terry in a minute about the FOMC side. I mean, COVID is very much something which features strongly in the minutes of the meetings and so forth. I mean, is COVID a big issue as far as the Bank of Japan's concerned, or is it something they're tending to sweep under the table?
Well, to be honest, because their policy settings have been so stable for so long, it's not having, I think, a huge impact on the policy outlook, because nobody's been expecting them to make a move even before this happened. But this is just I think reinforcing their view that this long-standing now extreme levels of policy accommodation is still the appropriate response. We can imagine a scenario where we didn't have this virus over the last 18 months and we had everything going great and people really confident and happy about the economic impact of the Olympics, and who knows what else could have happened, and then we might be having a conversation about perhaps it's time for the BOJ to start thinking about changing policy, but that's obviously not the world we've lived in.
Okay, I'm going to ask you about China. It seems that most of the talk there is that we are starting to see a slowdown in economy in general now. So I guess, is it the case that the slowdown's accelerating? And I mean, of late there's been a lot of talk in the media about the government's regulatory crackdown on some of these leading technology companies. And I suppose the question there is, do you think that poses a danger to longer term productive potential as far as China's concerned?
That specific issue, is definitely one that's caused a bit of raised a few eyebrows. But more broadly, I don't think that's going to be the number one issue that impacts the long-term trajectory of those industries and sectors. But they're again just wrestling with the short-term impact of COVID. But what we are seeing is there has been a bit of a gap between the manufacturing and the service sector PMIs open up over the last couple of months. So that's possibly an encouraging sign that, perhaps the manufacturing sector, particularly, some of the outbreaks we've had down in Guangdong and other places, that's why we're seeing a bit of a weaker number for the manufacturing PMI. But perhaps the services sector is more broadly indicative of overall health of the economy. But that said, again, there's no real sort of rush to change policy in China as well. They've sort of tweaked their reserve requirements a little bit in the last couple of months, but other policy settings are still very much on hold. And we've had a few officials come out and saying that they're going to be flexible and cautious and prudent. The normal things that they say, but no real big change to the overall stance of monetary policy.
Right, so you say on that news, as well as you're sort of kind of implying, there's no change in what loan prime rates last week. Do you think
they've been on hold since last April? So
right.
I think they're again just waiting to see if there's any scope to start adjusting policy.
So first half of this year, I suppose one of the dominant trends in the FX markets was the appreciation of the Chinese currency. If we are starting to see, let's say a significant slowdown in activity in China, do you think the authorities are going to be that much more concerned about the path of the exchange rate?
Oh, definitely. They're always paying attention to what impact that's having on the export sector. So if we see external demand really weaken, they'll be putting a lot more attention onto the exchange rate. But they're obviously limited in what they can do on that front. But that's just one of the tools they'll be looking at.
All right, so let's shift across to your immediate part of the world then. I guess you still have lockdowns going on across a fair swathe of Australia, is it now? Do you think that's going to sort of slow down the pace at which we might see any quantitative easing coming out of the RBA? Or at this stage, is it still the case that it's just a question of when it happens?
Well, yeah, I mean, it's a good question, and it's one that is definitely being discussed at the moment. And so we had the minutes of the RBA meeting at the start of the month. So at the start of the month, they came out and said, okay, we're still going to start scaling back our asset purchases. They're not too aggressively. They're doing about 5 billion Australian a week, scaling back to 4 billion starting next month in September. So the minutes that came out 2 weeks later revealed that they had suggested, or at least raised the possibility of delaying that scaling back of those purchases from 5 billion to 4 billion. But they decided on balance that that's not the right thing to do. They thought that if they did keep it at 5 billion, it wouldn't really provide any near-term support. And by the time that it did get around to having a meaningful impact on domestic liquidity conditions, then they were hopeful that public health conditions would be improved. So the bottom line was they're still on that course of scaling it back, but at a gentle pace. But of course, the longer these lockdowns continue, the more likely it is that they won't scale that back any further, or they'll scale back the pace at which they start reducing these asset purchases. So I think it's a broader issue, not just for RBA but across the region. We've got central bank officials with plans and ideas and hopes and aspirations about what they want to do, but obviously the virus has different ideas about what they can do.
Okay, certainly over here in Europe, where the COVID numbers have started to increase again as well. There's been some at least early indications that it is now starting to impact some of the sentiment numbers, both consumer and in the business sector as well. Is that true of Australia?
Yes, you're going to, I think, see the most of the impact come through in probably in the next month's worth of data. But we are starting to see some of those indicators. And that's to be completely expected. With New South Wales now, which is the most populous state in Australia, has been in lockdown for 7 or 8 weeks now, and Victoria, the second biggest state in terms of population, that's also just had a series of lockdowns rolling into each other. So it's just impossible to expect that that's not going to have a huge impact on the numbers. And we're starting to see people think, okay, we could actually move into an official recession with 2 quarters of negative growth.
As bad as that.
That's not baking the cake yet, but that's sort of the direction we're heading, unless we get a bit of a pop pretty soon.
Okay. All right then. I'm going to ask you about New Zealand. I mean, beginning of last week, there was all the chatter in the markets that the Reserve Bank of New Zealand would be hiking interest rates at its policy meeting. As it turned out, we suddenly got this emergency lockdown being introduced, and the decision from the RBNZ was not to do anything. But it still sounds, from what I've seen, that the central bank remains extremely hawkish. So should we still be looking for an interest rate hike out there before the end of the year?
Well, they definitely want to, and I think you're right. Just before that meeting, they were almost ready to pull the trigger, and then they had this news just a couple of days before that New Zealand had its first locally transmitted cases in several months, and the government reacted very aggressively in terms of lockdown. So that obviously was the factor that kept them from pulling the trigger, and again, it just depends on whether these pretty aggressive measures are enough to stop the virus from spreading in New Zealand, because they have a very strict policy of going for COVID zero. So if that works and we have a quick sort of recovery, quick sort of a bounce back from lockdown, then sure, the RBNZ will be in position to do what it wants to do, but that's still an open question at the moment.
Because I thought it was quite interesting the way the New Zealand dollar traded last week, when it was being bid up in expectation of the interest rate hike. And as soon as it became apparent it wasn't going to happen, it really got hit in the FX markets quite hard, and has obviously dragged the Aussie dollar down with it as well. And you kind of wonder now, if they do come out and tighten before the end of the year, how much of a relief boost it's actually going to give to the currency market. So going to be an interesting one to watch. Okay, thanks, Bron. Anything else from your side?
Well, yeah, I mean, we were speaking just a couple of hours before the Bank of Korea announces its policy decision. Yep. So by the time that this is up and alive, we'll probably already have the decision.
Better get your call right. Better get your call right then.
Yeah, well, it's a very, very close call. I mean, normally on these things, there is a very clear consensus, and we have a pretty good read on what's happening. But on this one, it's pretty much 50-50 if you look at the sort of domestic analysts and economists. I think one survey had a majority saying that they're going to hold, and another survey had a majority saying they're going to cut. So it's really a toss of the coin at the moment. And again, we've got the situation where the Bank of Korea obviously does want to start scaling back policy support. We've had the governor there, Governor Lee Ju-yol, being pretty hawkish over the last couple of months, talking about financial stability, saying that even if he was to hike rates twice, we'd still have policy at very accommodative levels. So that had quite an impact on expectations going forward. But again, I think in just the last week or so, people have said, the COVID thing is again going to be the factor that keeps them from going ahead right now. So we'll see very shortly.
Okay, brilliant. Thanks for that, Bron. Right, moving on then to Terry. Jackson Hole Symposium Thursday and Friday. Looks as if that'll be virtual now due to COVID, but it'll be nonetheless important for that. So all eyes on Jerome Powell and any tapering clues. What's he going to say?
Well, I think he may well have to do a little tapering in his own speech, because the simple fact that just a few days ago the Kansas City Fed switched this to a completely virtual event tells us that the course of the pandemic is still having an impact on the economy. And that has been one of the conditions that the Fed has been keeping a close eye on. I don't think that markets are going to see the sort of specificity that they had hoped for from Powell. I do think he will discuss broadly the conditions under which they will taper. But I think he may also add a healthy grain of salt in there to let people know that September may indeed be too soon to expect it.
Interesting. Now, if it's going to be perhaps less, let's say, apparent than markets were previously expecting with regards to the tapering, do you think he's going to again come out and reiterate the fact that he wants to see an improvement in the labour market? And if it is going to be perhaps slightly less clear cut what he's going to say, it makes next week's employment report all the more important.
Well, and I think that really will be the pivotal piece of data as to whether the taper is announced for real in September or later on. We've had 2 reports in a row of nearly 1 million jobs added. Mm-hmm. It's unlikely we'll get quite that kind of number again, but we also have to look at the surveys of manufacturing and services in the US, which have in fact shown a great bit of slowing, although they're still expanding healthily. They just are not at the pace they were even a couple of months ago. So I think we can anticipate that the pace of employment is going to be somewhat slower as well. Now, will it be enough to satisfy the Fed about the substantial improvement they're looking for? Remains to be seen.
Let me ask you, how wide do you think are the current splits on the FOMC as to whether or not now is kind of the right time to start tapering, or we shouldn't really even be thinking about it yet?
Well, just to go back over what Fed policymakers always say about no decision is made before the meeting and everything depends on the data. I think at least among the current set of voters on the FOMC, it's probably about a 50-50 split. So that's not particularly helpful. The FOMC as a whole, I think probably the majority, at least a decent majority of them, would like to start the taper. I think there are worries about imbalances, about this going on too long, about the size of the balance sheet being astronomical now. So I do think that the reasons they started the asset purchases in terms of establishing financial stability and providing markets with liquidity aren't really the reasons now. So the U.S. economy is going along pretty well. Third quarter looks like it's going to be not as strong as the second, but certainly show good growth, probably somewhere in the 3 to 4% range. So, you know, the need to provide that much stimulus via asset purchases, they can now make a good argument that it just isn't needed.
I must say, that's a very fair point, and I think, as we record the podcast, there's increasing talk that perhaps, talking about tapering is all very well, but is it the case that the current stance of policy is even appropriate, given the way the economy in general is moving at the moment anyway? Is it the case that monetary policy in terms of quantitative easing is actually still appropriate to do the kind of job that it's supposed to do in the first place? Okay. Anything else from your side, Terry, in terms of what we should be looking at the US economy or whatever from your side over the course of the next week or so?
Well, I think we're probably going to see consumer confidence numbers continue to be weak relative to recent months. But a lot of that is some of the really bad news coming out of Afghanistan. I think worries about inflation seem to be beginning to not exactly fade, but they're taking a back seat to other matters. I think people are actually getting a little bit used to higher prices. So the sense of urgency there isn't quite the same as it was.
That's interesting, because if we sort of move across to my side, I guess we're seeing a similar sort of picture in terms of some of these surveys. So, for example, consumer confidence for the Eurozone area, we'll talk about that first. That fell for a second consecutive month in August. That's down to its lowest level since April. But looking at some of the details there, it does seem to be the case that although inflation in the Eurozone, and what the headline rate is only running at 2.2% at the moment, so well down what you have US side anyway. There are signs now that these surveys indicating consumers are getting a little bit worried about the implications of higher prices on real disposable incomes and the like. And in addition to the rising trend in COVID, that's actually starting to to hit some of these sentiment numbers. In any rate, I guess in line with what we've seen pretty well around the world at the moment, the likes of the PMI surveys and most of the business surveys for the Eurozone anyway, suggests that we might well have seen the peak of growth since the COVID recovery started. For the Eurozone, the flash August composite output index in the PMI survey, so the, if you like, the GDP proxy, that was 59.5, which to be honest is still a very good number in historical terms for the Eurozone, but it was still down from 60.2 and weaker than expected. And don't forget, a lot of these surveys are still biased up by the fact that prices are still strong. We still got delivery times continuing to increase due to this ongoing problem with raw materials and indeed skilled labour shortages in many instances as well. Also out of Germany today, we had the EFO survey, which in many ways is perhaps the most regarded of the business surveys within the Eurozone. That found the expectations component within that hitting its lowest level since February. And morale was down in what manufacturing services and retail trade as well. So pull all that little lot together, and it does suggest that although the Eurozone is certainly still growing at the moment, there's downside risk to it, and it certainly appears to be coming in somewhat short of what markets have been previously anticipating. Pull that lot together, then bar the fact that inflation is still moving up. Indeed, it's a little bit above target now. It does suggest that the ECB will continue to be generally dovish. And looking ahead into the fourth quarter, I think built into the market now is some kind of expectation that we will get a limited amount of quantitative easing tapering. This will be by the PEP, the Pandemic Emergency Purchase Program, which was raised a few months ago to try and settle down financial markets when we had all those bond yields going through the roof. Well, it looks now as if the expectation is that we'll see a little bit of tapering from that once we go into the fourth quarter, but there'll still be a sizable quantitative easing program being undertaken by the ECB, which I guess amongst the major central banks at the moment looks likely probably to be more dovish than any of the others. What else have we got from my side? Well, as far as the UK is concerned, it's a similar sort of story, but if anything, the slowdown here may be starting to come through a little bit more quickly, particularly going back to these PMIs. I've got to just say, just to reiterate, that certainly as far as Europe's concerned anyway, the PMI surveys have not been a particularly good leading indicator of actual GDP numbers. But in any event, since markets are so focused on them, August PMI then for the UK, the composite output index, that was down at 55.3. Again, historically pretty decent, but that was almost 4 points below where it was in July time, and indeed a 6-month low. And again, this continues to reflect the problems, ongoing supply chain disruptions, and increasingly in the UK, the skilled labour shortages, which poses a right raw problem for the Bank of England, because we are seeing wages over here continuing to accelerate at a time when GDP is slowing down. So what are you supposed to do with policy? But the bottom line, I think, is that most of the survey evidence and indeed the hard data evidence are pointing to a slowdown, possibly a sharp slowdown in third quarter growth. And on the back of that, not long ago, we were talking about the chances that the Bank of England might be forced to end its quantitative easing program early due to inflation, being well above what was expected. Well, given what's happening to the growth numbers at the moment, if anything, it looks like that has kind of gone out the window. So I think certainly by the end of this year, the quantitative easing program will have finished. But any idea about a hike in interest rate at this stage is probably a long way in the future.
Jeremy, what does the Bank of England forecasting for inflation over the next 12 or 18 months?
Well, they've got it rising now above the 4%, heading towards almost 5% during the course of the next 12 months or so. But of course, to justify its decision, not to change policy, it's also got it coming back down to hit target. So its medium-term 2% target within sort of a 2 to 3 year period. So it's very much consistent with a view we've got coming out of, well, let's be honest, a lot of central banks at the moment, whereby it's, the current rise in inflation is transitory. It will come back down again as we get the base effects from COVID falling out, all price base effects falling out as well, et cetera, et cetera. But I think it's got to be said over here that that the rise we're currently seeing wages is becoming a genuine issue. Clearly, there's compositional effects in there because of what the furlough program's done and everything else. But nonetheless, it does seem as if there's a genuine underlying acceleration in wage growth, which, if it is sustained, it's going to make it difficult, I think, for the bank to get its inflation back down towards target over its current projection period. So I think, if nothing else, the UK is going to be an interesting one to watch, I think, at the moment. ECB, by and large, looks to be relatively simple in a sense that tapering or not tapering. Their policy is not going anywhere in a hurry. For the Bank of England, no, it could be quite interesting to see what they're going to do if inflation does go on higher for that much longer. One other thing I'll certainly mention from my side, I guess, really in terms of just looking at these COVID numbers, as we've talked about, throughout the podcast, they are certainly impacting significant parts of the global economy. And I suppose you've got to say, simply by more than expected, since the original hopes were that we wouldn't be in the kind of situation we find ourselves in at the moment, even just a couple of months or so ago. But there was a large-scale UK study released last week or the week before, which found that while COVID-19 shots work, they're less effective against the Delta variant, which is clearly becoming the big problem now for most of the globe, and protection from the vaccines wane after about 90 days or so. So while vaccination rates are clearly going to continue to have a big say in investor sentiment towards those countries where inoculation rates remain very low, hospitalizations are going to become an increasingly important metric elsewhere. I mean, fortunately, death rates amongst the vaccinated remain well below the levels seen during the previous virus waves. But at the end of the day, an extra work in hospital is still not good news for GDP. So bottom line, I guess, out of all of this, I think as we've all kind of intimated, where COVID goes from here is going to have major implications for growth and indeed ultimately economic policy in general. Okay, that is it from me. Anything else to put in the pot?
No, I mean, only the focus here in Australia is very much on that issue of whether we can live with this Delta variant without it overwhelming our hospital system, and whether we get to a level of vaccinations that will allow us to move away from this policy of just locking down.
Can I quickly interrupt, Brian? Your vaccination rate is still pretty low, isn't it, in Australia?
I think, well, compared with you guys, yes, and some of the other leaders, definitely. Compared with some other places in Asia, though, it's better. So it just depends. We're definitely have picked up the pace in the last 6 weeks or so, but we're still coming. We've still got a fair way to go.
All right. And Terry, just to round off for you, just in terms of COVID US side, what's actually going on there at the moment? Because over here, the numbers stateside look to be, somewhat grim. Is that the sense your side, or are people not particularly worried about it?
I think it really depends on where you live. I mean, right now, the southeastern portion of the U.S. is a real COVID hotspot, and it is a deep concern about that traveling elsewhere. And it just sort of depends demographically where you are on what the vaccination rates are. So I think the areas with high vaccination rates aren't particularly worried. And, just anecdotally, the people I know who work in the healthcare system are saying they are absolutely overwhelmed right now. So I think it is a concern. I think people see it spreading. There's a lot of talk about booster shots now for, especially for vulnerable populations like the elderly. So I think what we're going to see not only is, and we've just had FDA approval for, I think it was Pfizer shot.
Yeah.
So that may encourage those on the fence about getting vaccinated or not to get vaccinated, but it's probably not going to convince the unfortunate large share of the population that is resisting getting a vaccine. But so I think what we're going to be seeing is a push to get the unvaccinated vaccinated, and a push to get the vaccinated get their boosters.
Yeah. One day the world will get back to normal, but not tomorrow. Okay, well, that's it from us for now then. On behalf of Terry, Brian and myself, thanks as always for listening. I'm taking some leave next week, so the podcast will be back in the following week. However, in the interim, do keep up to date with all the key market moving data and events in Econoday's comprehensive global economic calendar. We'll see you next time. Bye for now.